Hey, this is Sasha. Thanks for joining me in today's video. And what I want to share with you today is how to buy a call option and how to profit from it step by step. So a lot of people are looking for a directional move. So rather than buying a stock, you might want to go ahead and buy a call option. So that's what we're going to cover in this video. So stay tuned. All right, so for many people, you might be interested in going with a call option because you think the stock is going to go higher, so you want to go ahead and buy the call option. When you buy a call option, what's happening is you go ahead and have the right to purchase that stock at some future date and time at a certain price that you determine. So that is known as the strike price. Now, can you get out of it early? Yes, absolutely. Do you have to buy the stock shares and then sell them later? No. Why not? Because the value of the call option, the choice, this contract that you get will become worth more. So you don't have to go ahead and buy the shares and then resell them later. You can just go ahead and sell the contract because it's now worth more money to somebody else. So in order to go ahead and do this, I do want to let you know that it's not the smartest approach when you're looking at a directional based trade. I would recommend you learn a little bit more about option trading, and you can do that on our website at tradersfly.com. Start and then go to options. It's just right here, Option Trading 101. And there's a lot to learn when it comes to trading options. So I don't think buying a single option contract is the smartest approach. And I'll share with you that why as we go through kind of this trade example. So let's say I am interested in Facebook here, and this might be the trade I want to go ahead. So if I want to go ahead and buy this stock, and let's say I'm interested in 100 shares, confirm and send. When you look at this, buying 100 shares of Facebook, you're going to be paying about $23,000 at this point in time. So $23,000 is quite a lot. So what many people are interested in doing is buying a single call option contract. Now, you could go ahead and look at the calls right here. Here's our calls. It states right there, there's the calls. And right here, I have my days till expiration. And here is the date. Okay, so if I go July right now, that would be 57 days out. And as I scroll down, you'll see in the middle right here, I have strikes. So these are known as the strikes. So if I think the stock will go to 270, I can get a call contract for the price of $2.29. If I think it'll go to 240, I'll pay $10.30. Why do I pay more for the 240 versus maybe the 270? Well, it's because 240 is a lot closer to the current price. That means it has a higher chance of success. So to have a higher chance of success, you got to pay up because current price is 234. So remember that an option contract, when you're dealing with it, a single option contract is controlling 100 shares. So one contract controls 100 shares. That means if you're buying this one, you're actually paying not just $10.30, but you're actually paying $1,030. Now I'm just going to go ahead and right click, go to buy, and then buy a single. And you'll see this gives me that one single option contract, and I can go ahead and analyze the trade. So here I am on Facebook. I have one single call contract, and you'll see that my profit and loss, which is the green line, is going to show me negative $1,035. Why is that? Well, it's because remember we said it's controlling 100 shares. 100 times 1035, we get $1,035. That means $1,035 will be taken out of my account as margin, as kind of collateral, holding it until we see what happens, until the stock either moves up or moves down. Now, if I'm interested in this contract, I could go ahead and place the order, and you'll notice I have two lines here. Now, these two lines represent my time at expiration, which is the green line, or now I'm making it yellow. That's at expiration. And the white line is today. So you'll see a little bit of a curvature on that. So today, if it moves up, let's say to 250, you could go ahead and make $855. See, my mouse is moving over here. How is that possible? Well, it works in this way that right here, the 250, I line it up, and here's my profit and loss right over here. And right here is my zero line. So you kind of match up. Here's your price, stock price. If it's 260, you match it up and you move it over and you see what the profit and loss would be. And what it's doing here is it's taking kind of the stock movement along with all these other values, and giving you kind of an estimate of what your profit and loss will be at that time. Now, the issue with a single call contract is you have time value that works against you because you're buying something, it expires, right? You've bought it 30 days, 60 days, 45 days out in the future. And when that happens, well, you lose time value, just like on an insurance premium contract. In our case, this is known as the theta. And in our case, we are losing $10.90 every day. And you can see what's going to happen here. My profit and loss right now, because of the bid-ask spread, I'm down about $12. I could go ahead and move this theoretical time forward, and you can see I'll lose another $10. If I go ahead the next day, I'll be losing $11. So if I move it to the next day forward, I will lose about $32. So I'll go ahead, click that. You'll see I'll be down about 32. And you can see this process and why a lot of people who buy single call options actually lose, or buy a lot of single put options. They lose because they're betting on directional movements and not really making money from time decay. So you're paying for the option or the choice of getting this stock at a further higher price. Now, the cool thing about this is you can really leverage your position up if you don't have a lot of money. So for example, rather than paying, $23,000 to have the stock, you could go ahead and, create a replica of this, still getting some upside movement, but you pay a lot less. You pay the $1,000 instead of $23,000. And how does this work? Well, it mimics you based on your delta. This is in a way a 46 share kind of stock alternative, because your delta is 46. When you have a delta of 46, it means for every $1 move, you make $46. So a $1 move up, let's say we go ahead and move this up $1, which you're going to notice in the profit and loss right here is it's going to move it up about $46. So let's just go ahead here and move this up $1. So you see the stock price moved up $1, and now you can see we're up about $40 or so. If I move it up another $1, let's say we go up to $2, add 46 to what we had, about 40, 40 plus 46, you'll get your $86. So that's how it works, is that you basically have now 46 shares here with this option contract. If you go ahead and go, let's say, further duration to 60, well, you pay less. In this case, this one is a $405, and you can see that right here, 405, but you have less stock shares in a way. You have 23 stock shares, 23 delta. So if you mimic this in a stock share world, you make $23 for every dollar move the stock moves up. So let me show you how this works on the stock world. Let's say I buy this, and I'll buy 23 shares. So here's 23 shares, and you can see right there, this is a linear approach, whereas an option approach, you get a little more curvature because of the time decay and vega and many other factors. But here I have a 23 delta. You can see my profit and loss is at 0. If I go ahead and move this up $1, I will make $23. And that's how that works. And if you look at the option contract here, well, it's the same way. I've got 23 as an alternative, but I only pay $400 for this option contract, whereas 23 shares of Facebook, you can see it's going to charge me about $5,400. So paying $400 versus $5,400, that's the big difference. Of course, the downside to this when you're dealing with an option contract is you go ahead and you pay for that with the time decay, which is the theta. We have a negative theta here, a -8, which means every day I lose about $8. So you can see now I'm down 18. If I move this date forward again, I will go down about another 8 or 9, and that'll be down to $23 and so on. And what this does is that white line starts getting closer to that green line. White line is today, green line is at expiration. So you can see with time, I get closer and closer to expiration, which means if you're buying a contract at around 260, you have to move fast enough to offset the time loss that you're going to incur in this contract. Now, this is why I don't recommend single option contracts for most people. I mean, most people start out this way, and you're probably brand new or you're just starting out this way, but it's not the smartest approach. Normally, what we do is things like spreads. I'll show you this spread example. This is one on Wayfair. And this spread example has been up for about a week or two, in which you can see here the time decay here on the theta is positive instead of negative. And what we're doing is we're selling a spread. I don't care if that stock goes between about 116 to 230, you're still going to be making money. And if it expires, you make about $495 on 1,505 capital. So that's the way that this trade is working and functioning. We talk a lot about this in the courses that I have available. You can check that out on our website at tradersfly.com, and you can see a lot of those kinds of things. But in either case, I hope this was helpful. I'm going to go ahead and put this Facebook trade in for you, so that way we could go ahead and cover it in another video here soon, and you can see how it kind of functions and works and how to get out of it. So we'll talk about how to get out of a single contract here in another video. So I'll go ahead and put this one in. To get in it, you right click, confirm and send, and you can see there's your kind of trade order. And then you go ahead and send that in, and I got filled, and boom, and now you can see my trade is there on Facebook, moving and wiggling, and now it's ready to kind of get out if I need to. Anyways, thank you so much for joining me. Remember to hit the subscribe button right over here, or see some other videos on this side. And of course, you could check out and download some of the freebies that I have by clicking the link over here, along with some of the other great stuff that you've seen throughout the video. Thank you so much, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you in the next video.